All right, guys, welcome back for another video. In today's video, I want to give an update on the Bitcoin trade I'm in. Roughly an $800,000 of profit. You can see right here, basically account equity roughly at 3 million. I can see the account history right here. Taking some wins, taking some losses, but a pretty decent position right here. I got this position down from the low down here. Really just actually back here around FOMC. Some of the hedging and trading actually brought the cost basis up a little bit more. It's pretty unavoidable. Whenever you're hedging, you tend to draw that cost basis up as opposed to just hedging that position, or excuse me, letting the position ride. But even still, it's still got a very favorable cost basis down here at 18,444. And again, in $800,000 worth of profit. It's a 340 Bitcoin position. Now I'm going to run through some of the rationale for why, basically where I think price is going from here. And the first obvious thing I want to talk about is the daily close, right? We got a daily close above these highs right here. Now people are looking at these, this is a confirmation and it is on decent volume. You do have this close coming off a volatility contraction and then expansion volume, close above. Now we want to mark off these highs right here. We also want to mark off this daily close right here. If we go down to a 2-hour chart or even an hourly chart, you can see how, price is kind of consolidating around that daily close. We want to focus on these highs, right? That daily high we marked off, that old significant high. Because if you are going to put in the swing failure pattern here, you would see this area close below. Now, we haven't tested it after the daily open. So what you would want to see is you'd want to see price come, if it's going to retest this area, just come down, retest, back into this candle right here, this wick high and this body right here, test down, and then rally back up and close higher, right? And ultimately close higher above these highs right here. Now, if price hangs out around this level, that's really not a good indication if you are bullish, right? If you are bullish, you want to see price move more quickly than if you're bearish, right? If you see price breach liquidity in this way and then hang out at that level, it's generally not a good sign, right? It's typically going to signal a reversal, right? And that's one way to incorporate the element of time into these swing pattern failures, right? If you're bullish, the bulls don't want to waste any time. You want to see price move. If you're bearish, you want to see either a very quick sell off, quick and dramatic sell off, or a consolidation at this level. Because what you typically see there is, right, when you get this close above, the first pass is always going to be a buy, right? Almost always, even if it's going to break down, right? So you'll see a test back down into this level. Now, again, this is no guarantee that this will happen, but it's a good expression of how the first pass is different than the second pass. So if you get a test back down into this level, this old daily high that we marked off right here, that is confluent with these lows right here. So you could get a test back into this daily level and get a stop run below here, and then take out the stops below here and then rally upward, and you see that daily close up much higher, right? But on the flip side, if you see that just turn out as a scalp, right? If you see price come down here, retest off this level, offer a little bit of a bounce, and then collapse lower and close again below this area, there's your swing failure pattern right there, right? If you are bearish, that's what you want to see. Now, there's obviously no guarantee that would happen, right? If you are bearish and you are holding on to short positions from within this consolidation, you're in deep shit right now. You're in a lot of trouble. You need to be managing risk, or because price can run, right? Price can run very quickly out of these levels, especially considering the amount of time it's spent consolidating at this level. When you get that volatility contraction, you don't want you don't want to be like a deer in the headlights when the volatility does expand. So ultimately, obviously, that's what everybody's looking at. That's how we would trade it. These vertical lines that you see on the chart, they are representative of different significant uh, points in time in the market. So here you have your Q3 open in July, and Q3 runs all the way until Q4. You've got your Q4 open right here in October 1st. Typically, they serve as pivots on the market. If you see some of my previous videos, you know kind of the rationale behind that. But this here too, this is we've got the FOMC meeting from September, and this marked off here is the coming FOMC meeting in November 2nd. Now, if you go back in time, you can see that previous FOMC meetings have typically served as a bottom in the market, even in the midst of a very brutal downtrend in 2022. You see those areas kind of serve as very temporary bottoms, even in the obviously, even if price goes much lower after, it can serve as a temporary bottom, run up to get liquidity, and then drop down. The reason for that is because, going into those FOMC meetings, the market is pricing in a sense of uncertainty in the market, right? Even though the Fed has indicated that they're going to raise interest rates and they're going to do something bearish, the the market doesn't know what they will actually do, right? And there's always the possibility that they might do something even more bearish than what they said they were going to do, right? So if they said they were going to raise 0.50 or 50 basis points, they may actually raise 75 basis points or whatever. Now, when you get the actual results, right, and typically the Fed comes out and does exactly what they say they're going to do, that relieves that sense of uncertainty, and you typically get a relief rally in the market, right? This is very characteristic behavior, but of course, that's under the assumption that they do exactly what they say they're going to do, right? You could have a bearish surprise, but that's the way the expectations play out in the market, right? The Fed creates a set of expectations. They try to meet those expectations, right? So even though you have bearish or bullish expectations, if they're met perfectly, it's nothing. It's not an event. But if they're not met to one direction or the other, then you have a bearish or bullish event. And of course we have that coming up in November 2nd. So who knows? I would be totally speculating. Well, I do think the most likely scenario is that they raise 75 basis points like they said they would do, and then you probably get a relief rally once that relieves a sense of uncertainty. Now I know, we're kind of already rallying into that, but I still think it would add a little bit of fuel to that rally. I know that's going to sound contrary to a lot of people who, you know, think that raising interest rates should never lead to a rally. I'm just talking short-term volatility. I'm not talking long-term. But that's a whole different video in itself. And we also don't know where price will be when the FOMC meeting comes November 2nd. We could put in a swing failure pattern right here and then be trading much lower. You just don't know. And so it's very difficult to create a bias around what will happen, but it's just much better to map out, okay, what is happening, when is something that's important likely to happen, instead of trying to like predict and pull out our crystal ball about what will happen. Just identify where the important things are likely to happen, and pay attention to them when they are happening, so we can react to them in real time. Now anyway, assuming that this area is broken, which I do kind of assume, right? Because if we get the weekly close here or higher, and really you'll get, the weekly close on spot doesn't really close until Sunday, but for all intents and purposes, you can use the CME close Friday afternoon. If we close the trading day on Friday anywhere around this level, then you're confirming, weekly bullish divergence, not only weekly bullish divergence, but weekly bullish divergence coming down at the most extreme RSI read ever in Bitcoin's history. And Bitcoin has never had weekly bullish divergence, right? And that's coming off a capitulation, the largest capitulation in Bitcoin's history. and a period of significant volatility contraction down at the capitulation lows, right? On bullish divergence, building bullish divergence. And now stochastics are expanding to the upside, right? And about to cross up. If the weekly closes up at this level, then your stochastics will come up and close up out of the critical zone. I know I'm getting a little bit ahead of myself. I'm assuming that price will close at this level or around this level. And this is obviously operating under that assumption. So EMAs, the exponential moving averages, take a little bit longer, obviously, to curl around, but you do you do have something kind of starting to form here, but not really. It'd be more apparent on. You'd have to go down to a 12-hour chart to see that, right? So you see the 12-hour kind of making its move upward, and what do we see on the stochastics? Yeah, similar idea. 4-hour, similar area. I mean, really, all that happened here in Bitcoin is, price just got pushed into this period of very low volatility, and it was forced to make a choice, right? Ultimately broke to the upside. Now we actually see some price movement right here. Price is moving down, getting a little bit of a retrace right here, coming below these lows right there. Can mark that off. It's an intermediate time frame low. Let's see, we'll go down to the minute chart. Yeah, you can see the volume coming in here, spiking right there. Again, the same concepts apply that we were talking about on the daily chart, with the breach above this high to the breach below this low, and the liquidity concepts still apply right there. Now, of course, it's a much lower time frame, so you need to attribute the significance to the time frame where it belongs, but the same concepts do apply on different time frames, from the high time frames all the way down to the low time frames. Now, I do want to talk about, assuming this is, a macro bottom. This is, that we did see capitulation. We are seeing bullish divergence, and that price will bottom out here. I do want to talk about what targets I'm looking for. And I know this is going to sound a little bit crazy to people who are caught up in the momentum of, everything that's happened in the last year and how powerfully price has gone down. I mean, you can almost feel the weight of gravity when you look at this chart, right? I mean, you can feel the gravity pressing down on you. But, of course, that is market psychology, and that generally is going to get you on the wrong side of the trade. And where would I be looking for price to reach to if this is a macro bottom? Of course, that's a big if. But if this is a macro bottom, then really personally, I would be looking at this area right here as an area of extreme inefficiency, and these areas typically get filled. So the number one area I would be drawing my attention to is this area right here, this consolidation base right here. I'm going to mark this off, and this will kind of tie into some very interesting concepts right here. At least I hope are interesting. So you've got your inefficiency created here. Inefficiency is marked by the fact that you had very, very little retracements, right? You had this high right here, and then basically just straight sell pressure until you have your capitulation in June, right? This massive capitulation candle marked by extremely high realized losses. The fact that you have no real price restabilization or retracement makes it inefficient, and how volatile it moved. So I'd be looking for this to get filled. So if this does rally, I would be looking for price to run up to 36,000. It's probably a bearish retracement if you were to draw this. Yep, look at that. Perfect bearish 618 retracement right there. That is a very, very clear and obvious level for multiple reasons, right? It would also be a liquidity breach of this level right here. I mean, you've got a lot of things lining up at this level. And, obviously price could extend much further, but this is the, get on to first base type of play, right? This is your bread and butter, right? I mean, this is where you want to take the lion's share of your profit. Can price go further? Can price miss it? Yeah, of course, but this is the general framework that I typically would approach these swings with. Now, what's interesting about this level is, price formed a top and sold off very dramatically just on the possibility of interest rates, right? The promise that the Fed would raise interest rates. What's interesting is the Fed didn't actually raise interest rates until right here, actually this March meeting. And if you mark it off right here, it kind of goes back to what we were talking about previously about the the FOMC serving as a temporary bottom in the market by relieving, offering a sense of relief in the market. So the FOMC meeting actually came in right here. You can tell it by the period of contracting volatility, right? You have this FOMC meeting coming up, so the market finds a bottom, contracts into that data release event. Again, because the market hates uncertainty, right? It's contracting and liquidity is expanding away from the market. And then what's interesting here is you actually get your first interest rate actual hike of the cycle, right? The first time the Fed actually raised interest rates. Remember this whole sell off, that it was just on the promise of them raising interest rates. And here you get the first one, and that volatility contraction gets expands to the upside above these highs right here. And that's pretty interesting because that's a total swing failure pattern right there, and it runs liquidity above these highs, and then you enter your drawdown. But what's interesting about this is the brief window in time where there was a what would you say, like a massive drawdown during the period of actual interest rate hikes, right? So you've got one interest rate hike here, and then another interest rate hike here, and then that's it, right? You just have two during this before you get to your capitulation, right? So you had an FOMC meeting in here roughly, and that was also a bottom right here. I mean, briefly, right? You had your bottom, and then it ran up, grabbed liquidity, ran down. Same concept applies. But what's interesting is that it only took like 3 months of actual interest rate rises for Bitcoin to capitulate, right? Which is way, way earlier than the equities market did. Now, remember, Bitcoin topped out 2 months before the equities market and really bottomed out roughly 2 or 3 months before the equities market, too. So Bitcoin is a leading indicator. It's the best signal in the room. But, it's very interesting because if you think about it, it's a very brief window of time, right? It's just a couple months of that period versus when you combine it to this period where you didn't even have any interest rate hikes, and this period where you actually have the most interest rate hikes in this period, but Bitcoin is just stabilizing, right? Because it's already capitulated at this level down here. So that's kind of the framework for you know kind of, well, mainly capitulation is the reason why I wanted to buy the retest of these capitulation lows, again, in line with what we saw on the RSI, and also the fact that this is a retest of the all-time high from 2017. And, we are seeing that same volatility contraction expansion above. Could we see a throw over here and then the failure? Yeah, we could. But I don't think we will do that because we've already seen capitulation. I think that's really the key to understanding why the most of the downtrend is over, right? In the sense that these capitulation lows are going to be the macro low in the market, right? You do, of course, you have engineered liquidity to the downside, right? You have these price kind of programmatically pushing, creating new lows after that capitulation set in. But I'm really not looking for these capitulation lows to really be violated. I do think the macro low is in, and I'm positioned for that possibility. Obviously, with this trade here, and if going into next week's FOMC meeting on November 2nd, if we do get that Fed pause, or a shift in their policy coming off these capitulation lows, that's going to be extremely bullish. I mean, just lining up with everything else we're seeing in the market, and then you get that fundamental tailwind behind you. Also, some of what's going on in the reverse repo market. Of course, people are still in a state of fear, but as Warren Buffett says, you want to be fearful when others are greedy. and greedy when others are fearful. Hope you guys like this video.